Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, Ava Benesocky, and I'm joined by my co-host, August Binjaz. We have another great show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Now, our mission is to empower investors to earn passive income through real estate investing. We're really grateful because today we're joined by Dr. Tom Burns. A little bit about Dr. Burns. He is an author, a speaker, a coach. He is an orthopedic surgeon in Austin, Texas, and is a physician for the United States ski team. Dr. Burns is the author of Why Doctors Don't Get Rich, a personal finance book for professionals. And he is listed in the acknowledgement section of Robert Kiyosaki's book, Rich Dad, Poor Dad. He's also the co-founder of
Presario.
Presario Ventures, a real estate private equity firm. So we believe this interview with Dr. Burns will bring great value to physicians, dentists, surgeons, and other healthcare professionals looking to earn passive income from real estate private equity investments. Thank you so much for being here, Dr. Burns.
Thank you. Thanks, guys. Glad to be here.
Wonderful. So maybe we could start off by you telling us about your start in real estate investing, and what was it about this asset class that interested you enough to dedicate your time to learn more about it and eventually becoming an active real estate investor?
You bet. It kind of found me. In our life, if you're a professional or you're a doctor, you go to college, then you go to medical school for a block of time, about 4 years, and then you go to residency and sometimes a little more training. So during that time, I had no business classes. I was fairly entrepreneurial, but just I was basically an athlete that wasn't going to get paid to do that. So I became a doctor who took care of athletes. And while I was training, I was in the middle of my training, and this was the key point. We were trained by other doctors. So these were the guys that I was supposed to emulate and be like for the next 20, 30, and 40 years. And I started noticing that these fellas were a lot of times complaining about their life and kind of lack of control. Somebody else was determining their pricing structure. I found them in the hospital at 10, 11 o'clock at night when they had guys like me who had to be there, yet they were still in the hospital late at night. And often they were, they might have been on their second or third marriage. So they weren't smiling all the time. And I don't know if it was a touch of God or something, but something made me think that, I need to look for something else because I don't want these guys' money if I have to have their life. So I just didn't like the lifestyle that they were living and the feelings that they had about their life. So I started looking. I looked. At first, I thought maybe I'd wear a suit and go into administration. That was a dead end because I turned out not to be very employable. And I looked at the stock market, and it moved a bit too fast for me. You have to really look at that closely, and I didn't have any money anyway. So I started looking at some other things. I understood numbers, went to a little free seminar or two and understood compounding, understood money coming in, interest and things like that, and kind of fell on real estate. And the reason I ended up in real estate was that I thought it would bring me money that wasn't correlated with my job as a doctor. I needed something outside of medicine. And I found I could do it. It moved slow, which worked well for me. I didn't have to be first in or last out. I could do it with partners. I could do it part-time. I could do it full-time, do it by myself. So it just fit the life of a busy person or a busy professional. So I was able to at least get a foothold in the asset class and kind of grow from there.
Yeah, just to add to that, the simplicity of real estate. I mean, buying something that people live in, just it doesn't get more simpler than that concept when it comes to the asset class.
Absolutely. Okay, great. Dr. Burns, allow me to ask this question. Why do doctors don't get rich? It's the title of your book, right? So please answer that question. And to add to it also, we could ask, why are doctors forced to work into their 70s?
Okay, so and it's kind of a shocking title, and it was given to me by my friend who wrote the foreword for the book, but it turned out to be a good title. And it's not that they don't, and it's not doctors in general, but you can't, if you have to work for a living, you might make a lot of money, but if no matter what you get paid per hour or per procedure or per contract, if you don't perform that service, or put in that hour, you're not going to get paid. So if you get paid a lot, that's great. But as soon as you're unable to do that, the music stops and you don't have that money coming in. So that's not necessarily my definition of wealth. And so the thought process is that if you have to work for your money, you're not necessarily wealthy. Others will debate that, saying, hey, I worked and I have jillions of dollars, but usually that extra money is in some sort of investment that's continuing to grow. So, and then what was the second question about the doctors?
The second question was, why are doctors kind of forced to work into their 70s?
So, well, this kind of goes back a little bit, but again, they're, if they didn't get some good financial education, sometimes, some people, not all doctors or not all professionals, but some people might spend what they earn. It's kind of nice to spend less than you earn and use the rest to invest somewhere for later on. They're not necessarily, at least in that profession, they're not necessarily in charge of their pricing. You can be the best doctor on the planet and be right next door to the worst doctor on the planet, and the insurance company is going to pay both of you the same. What that means is that the insurance company is the one that's going to determine your pricing. And it's not necessarily been an upward trend the last 20 years. So it may have gone up a little or stayed flat while inflation's gone up like that. So what happens is there's lifestyle creep, and a lot of people have experienced this. You think, boy, if I could just make X amount of money, I'll be set. Once you make X amount of money, you're spending X amount of money. And so you think, well, if I make 2X that, I'll finally be okay. And so you just get that expense creep. And a lot of professionals get trapped into that. And without the thought of kind of paying yourself first and putting that money into something that's going to grow without your efforts. So that's sometimes the thought process. A lot of physicians are employed now. Back in the day, you set up your practice and you worked. You worked as much or little as you wanted, and hence you made less or more money. Now, a lot of people, over 50% of them, at least in the United States, 50% of them are employed, and they don't have much choice. And so they kind of have to keep working if they want to have a good nest egg. If they haven't created any passive income, if they're using the bucket theory and trying to create a big nest egg, then they got to keep going.
Yes.
Yeah. No, when I speak, sorry, I was just going to say.
Go ahead.
Go ahead.
Yeah. So now I was just going to say that, in my communication with our good friend, Dr. Drew, he talks about the options that exist for physician. He talks about as soon as you, in particular here in Canada, as soon as you're done, your residency and your med school, or eventually, and now, you come to a meeting. Royal Bank is there, is one of our main bank here in Canada, and they offer the options to you. Hey, here are RRSP options. Here are mutual funds. Here are some life insurance, and that's the options that they know, and that's what they invest into. And most of these investments have returns of 4 or 5% gross. So the options don't exist. So it's interesting that you mentioned that. For sure.
Well, and I'll tell you, and that's, and sometimes those industries, they might even fish in that doctor pond. They'll somewhat, if I can use the word, they'll sometimes prey on the physicians, and sometimes doctors, lawyers, architects, whatever, they may not know. I've had a number of people say, well, of course I'm an investor. I've got a mutual fund account. And, that's often sometimes more profitable for the person that sold you the mutual fund account than it is for you. Now, the last 10 years or so, it's been a great time to be in the stock market. But some folks only know that as a means of investment. And what you talk about on your show and what I talk about all the time is it's the passive income. Once you have enough passive income to pay for your bills, then you can decide what you want to do with your time and your money.
Absolutely. Dr. Burns, I was curious, what was it about multifamily in particular that enthused you?
Yeah, so I didn't start there. I've done all kinds of asset classes, but about a dozen or so years ago, my partner and I just decided, having done retail and land and manufactured housing and student property, we did a lot of stuff, a lot of office property. We've both been through a couple of recessions, and found that multifamily property, in part due to its granularity, if it's built or bought right, meaning good location in an area that's got growing jobs, growing population, even in a recession, they can hold their head up. And if you can hold your property through a deep recession, they tend to kind of rocket out of that recession. So we felt, and I felt for many years, that some sort of recession was coming. We all know it's coming. It's just that we'd be really famous if we knew exactly when it was coming, right? But we know it's coming. So we wanted something that was a little bit more recession resistant. Nothing's recession proof, but that's why we like the potential to live through a recession. The debt on multifamily is superior. We like the debt, and everybody needs a place to live. So it just fit nicely. So that's where our main focus is.
Fantastic. I always love talking to investors, and I say, through the 2008 financial crisis and through 2019, 2020 COVID pandemic, it was one of the best performing assets multifamily was. So
Right.
talk about that. Now, tell us about your connection with Robert Kiyosaki and the Bible of the real estate investors, Rich Dad, Poor Dad book that we like to call the Bible.
It's still to this day, you hear people say, I found this cool book, Rich Dad, Poor Dad. Now, that's changed a lot of lives. Robert and I have known each other for about 24 years now. For better or worse, I'm the guy that bought the first ever book that was sold. So, and I gave that back to Robert a couple of years ago and signed it up. He's framed it in his office. So we became friends back then, and we've done some projects together, and I've been to his seminars and his house, and we've just been friends for a long time. And that's the genesis of the book. Was we were sitting at lunch one day, and I asked him what his next book was going to be, and he told me, and he turned to me and looked at me and said, "You should write a book." He said, "You've got a story." So I kind of looked at him funny and thought about it for a while and decided maybe it's time. So that's why I wrote the book.
Amazing. I would love to get a signed version one day if we get to meet in person. That would be great.
That would be amazing. Now, to the next question, let's discuss founding a real estate private equity firm. How did the idea come about? And how about Presario Ventures investment strategy? What is the investment strategy, and why is multifamily the preferred property type you invest in?
Gotcha. So my partner and I met 20 years ago, back in 2001. So ages me. Of course, you can see the gray hairs here, but I was speaking for Robert Kiyosaki. I was on stage, and he announced me and said, "Tom's from Austin, Texas." So I didn't think much of it. I finished my spiel on stage, and at the break, a couple came up to me and said, "Hey, we're so and so. We're from the Bay Area. We're moving to Austin, Texas. Will you be our contact?" I said, "Sure." So they came, we met, and I continued to run into Darren, who's my partner. And in fact, I ran into him a lot. His shoulder got bad. I ended up operating on his shoulder. So that's my best tip. If you ever want a real estate partner, you need to operate on them, and then you can really get to know them well. But after about 6 or 7 years of seeing each other, and he was doing land deals and build-to-suits. I was doing bank deals and office and things like that. And we realized we had the same philosophy. So we teamed up together and did some stuff. And we did our first larger multifamily development in 2008, 2009, which was bad timing.
This was ground up development?
Yeah. So we cut our teeth on that. That's where we learned about the HUD program. And that's where it was right in the middle of the recession. So I could tell you all those war stories if you wanted to hear them, but that's when we started. And so it was under one name, and we just changed the name about half a dozen years ago to Presario, and it just pretty much focused on ground up development. We've acquired a few things, but most of our DNA is built into the development. So we develop multifamily and build to rent communities now.
Oh, right. Build to rent is a up and coming popular one, hey?
Yeah, it's really, really hot right now.
Oh, fantastic. All right, now focusing on this idea to promote passive investing for doctors. So you are a seasoned real estate investor, right? So we assume that your ventures have been financially beneficial, but you are still practicing medicine. So is it fair to say that the plan is not to leave medicine, but to create other sources of income? So not to get burnt out and not to be forced to work rather than doing it because you love what you do? Beautiful
question. So, well, for clarification, not all ventures have been good. Of course, enough of them have been good to work. It's been probably 12 or 13 years that my income from real estate eclipsed what I made as an orthopedic surgeon. And I kept being a physician. I enjoyed it. I really liked it. Now, why did I enjoy it? Because I grew my real estate business as I grew my practice. And so as the passive income started coming in, if there was something that was uncomfortable or I disliked or took too much of my time, I could eliminate it because I had the passive income not to care about what revenue I might be missing. So I really enjoyed my practice. And up until April of this year, I had it. It was great. I only worked in the mornings. I worked 2 to 5 mornings a week, did not work afternoons, and had a perfect team. Loved the practice of medicine. I enjoyed meeting my patients. I could spend as much time as I wanted. But due to some other factors, I didn't want to leave medicine, but I was pulled out of medicine. So I actually retired in April of 2021. So
Okay.
Wow,
Congratulations.
thank you. It took me 6 months to decide. I didn't know if I was, I didn't know how it was going to be to miss medicine, but it's been a good decision. It's allowed me to, it's kind of cut my geographic ties. So I can do my business from anywhere in the world. And that's what I like to do, is travel. So I'm off and out and about a lot. So, but that's the premise of the book. It's not, you'll rarely find a physician that got into medicine for the money. It's too hard. There's too much work. It's 10 years of work, and there's easier ways to make money. There's some surety of a reasonable lifestyle for sure. And nobody should feel sorry for doctors because they make good money, but they didn't get into it for money. They got into it for one reason or another. They liked the white coat. They wanted to help people. They had some seminal event where they decided they wanted to be a doctor. So the reason to talk to doctors and others about creating passive income is it does what it did for me. I didn't realize how blessed I was to have this happening. I was able to enjoy what I did for a living and eliminate the negative things. So what I want, and hopefully what you want, you guys are younger than I am, but we want happy, passionate doctors taking care of us when we're old, and 50% of them at one time or another wanted to quit medicine. Every other doctor you meet, at least in the States, at one time or another wanted to quit. So we're not rescuing people from cubicles. We're enhancing a profession and a calling for a lot of people. So that's why I talk so much about creating passive income. And you're right. You mentioned early on that there's, sometimes some people didn't understand that always, but it makes a better physician. I think it makes a better doctor.
Very well said. Thanks for sharing that. Now let's discuss this concept of financial literacy. And particularly here in Canada, the topic of investment and wealth building is a taboo subject in most physician circles. What is the mindset here? I personally rather my physician to be financially well off rather than having them to go to work, right? And to work.
Having them have to go to work.
Have
right?
to go
Yeah,
to work, yeah.
Yeah, you bet. So if you've got a physician that only makes money if he charges you more, or does more procedures on you, or sees more of you and sees more people and sees you less time, that's not a great relationship. So and a lot of them are under that kind of pressure, and it's not their fault. It's pressure that's being put on them from above or put on them economically. So it's if you can just eliminate some of that stuff, you can really enjoy what you do a lot better. I missed the second half of that question. I might answer that again if you.
Yeah. I was just, there's this, the topic of investment and wealth building is kind of
That's right.
taboo in most physician circles. So
That's where I got lost. I apologize for that. Yeah, and it's silly. I mean, I was told back in the day, this was so long ago, I was spending my extra time learning about financial literacy. I was learning all kinds of things. I was spending the money and the time to buy the books and go to the meetings. And at one time they said, well, that you must not be, that makes you not as good of a doctor because you should be focusing on medicine. That's like saying you shouldn't play with your kids. You should be focusing on medicine. So I was taking the extra time. I burned the candle at both ends for quite a while to try to create that lifestyle. And so it's, at one time it was a bit taboo, but I don't think it is now. There's a big upsurge in a lot of people in the medical and dental world that are trying to learn about this. I think it's really become a thing in the last 5 to 10 years. And so less taboo. And I think that probably runs parallel with the way medicine's going because it's becoming more corporate. A lot of private equity firms are buying out practices. Those get run efficiently, which means they get run corporately, which is not always the best for the patient or the doctor. A lot of mergers, a lot of larger organizations. And so as medicine's become more and more corporate, the freedom and autonomy has declined and declined. And so people are starting to search, and I just was on a call with a physician yesterday, and he used the word trapped, which I've used in the book, and I've used a number of other times. Is they often feel trapped because they weren't educated on what to do. They're told to go talk to your financial planner and give them all your money. I don't need to invest. I've got a guy. That's what some of them will do, and that's all they know. So they just don't know what they don't know. So, but I would say there's a higher percentage of people now that are really interested in learning how to take care of their own financial house than there were years ago.
Got it. Now let's switch the conversation a bit into how to service and how to help physicians who want to invest in real estate but might want to do it passively. Now, physicians are known to be autonomous. They're specialists. They're special in a certain field, and at times they're one of the only people in the world that understand the most about that particular aspect. And it's difficult to now bring them this concept of real estate private equity or syndication, where there are investors who are silent partners and the general partner who manages the project, but is pretty much hands off for the investors. How do you convince a physician investor to invest in a partnership where they're sitting back, writing a check, like Ava likes to call it, and for someone else to steer the ship?
Well, first of all, believe it or not, I never convince anybody to invest in anything. I just educate and make things available. But the good news is, physicians, they're experts at learning stuff. And I've known plenty of doctors that I'm just in awe of what they've done outside of medicine, started businesses, started real estate companies. So physicians have, they've certainly got the mental goods, and it's just a process of education and explaining the leverage of having, somebody that has the money and somebody that's got the time and experience. You marry those two together, everybody wins and everybody profits. That's how I explain it. And furthermore, if you're a busy doctor, what better way to leverage your time if you're making extra money, which most doctors do. They don't all, but most of them do. Then you can keep doing what you do what you trained 10 years to do, and what you may have done for 10, 15, or 20 years. That's what creates the gunpowder that you use to put into a syndication, and it takes none of your time. Now, it may take a little time early on, because if you educate them, you explain to them how to evaluate things. And as you guys know, you do one deal and you learn a lot, and it takes maybe a certain amount of time. The second deal you do, it takes less time because you've got the experience from the first. So they do one or two, they get good at it. So that's how I explain it. It's how you can grow your money without putting any of your extra time in. And that extra money will hopefully buy you more time in the future.
Well said.
Well said, Dr. Burns. Now I'm curious, what are your predictions for the multifamily sector in 2022?
I wish I had a crystal ball. I'd be super famous. So I think our projections are that it's still gonna do well through 2022. I think the Fed's starting to get a little shaky, and I think indications are that interest rates are going to go up. So it's going to decrease asset prices a bit. But again, if you're a passive income investor, you don't as much have to worry about the asset prices. But I think cap rates will probably stay compressed through the year. I bet you they'll lag behind they'll probably lag a bit behind the interest rate rise. So I think we're okay through 2022. And who knows what's going to happen if interest rates can't go too high, because the Fed can only take, at least in the U.S., the Fed can only take rates so high, and it's going to impact the federal debt pretty heavily. So I think we'll go sideways for a while, but I think we're okay. I think we're all right. At least we're projecting, because we're starting projects that take 2 years to build. So fingers crossed, right?
Fingers
Absolutely.
Crossed. Right on.
Great.
All
Awesome.
Right.
Really, I appreciate that. Now we're going to move on to the next segment of our show.
The 10 championship rounds to financial
Okay.
freedom. So whatever comes top of mind, and it'll be I'm really looking forward to your responses.
Absolutely. Same.
Me too.
So the first question, Dr. Burns, who is the most influential person in your life?
I'd probably say Robert. I'd say Robert from the business standpoint. Yep.
Perfect.
Robert Kiyosaki.
Robert Kiyosaki. Now, what is the number one book you recommend?
Who, Not How.
Oh, good one by Dan
Yep.
Sullivan.
Yeah, excellent.
All right. Now, if you had the opportunity to travel back in time, what advice would you give your younger self?
Ooh, wow. I'm not sure. I would probably just tell me to always think of the other guy still, I wouldn't change anything because where I ended up today is where fate and life has brought me, and I'm pretty happy to be here. I think I would just try to tell myself to always probably keep my mouth closed a little longer, my ears open a little bit more.
We have
Little
one
bit.
mouth and 2 ears, right?
Yep.
All right. Next question. What's the best investment you've ever made?
Uh, it's a doctor investment. It was in a surgery center. I have to say that I put in a certain amount of money, and in 2.5 months, I had that money back, and it produced money for years. So you don't get those very often outside of our sector, but it was financially the best IRR I've ever had.
Nice. Now, what's the worst investment you ever made, and what lesson did you learn from it?
Whew. I tried to buy an apartment complex by myself,
Hmm.
small one. It was 22 units in a town south of Austin, and I didn't know what I was doing. So I learned that management is key because I hired what I thought was a good manager. He put his son in there to manage, uh, who decided that he wanted to go to the bar rather than manage. And it came with a big block of tenants that came from another place, like a halfway house kind of place. And as soon as I bought the place, that contract dried up. So I learned to learn a little bit more about the asset class or the property before I take it on. I got out of it, just barely got out of it with my shirt.
All right.
Got it.
All right.
Now, Dr. Burns earlier mentioned that he has retired. This question is about a retiring topic, but kind of,
Yeah.
go ahead, go ahead. Eva.
Yeah, let's ask, yeah, let's see what you have to say. So, we usually ask, how much would you need in the bank to retire today? What's your number?
So I don't have a number. I never had a number. Uh, People always ask, they always ask, what's your net worth? In certain circles, they'll ask, not over cocktails, but I never knew. I only knew when I had to send it in. I get underwritten a dozen times a year by the banks, but I never knew. All I wanted was enough passive income to cover what it cost for me to live. And I had that on a QuickBooks spreadsheet. So I knew what my utilities were, what my house payment was, what my car payment, all those things. And I just watched that each year. And as I just knocked a section off here and there. So I don't have a number. And so that's kind of the bucket theory. If you get a big bucket full of money, you live off of that until you die. The problem is our buckets get leaky sometimes. They get rusted and they get holes in them. The money leaks out faster. And how big of a bucket do you really need to know? How big of a bucket do you need? Are you going to live for 20 more years? Or are you going to live for 50 more years? I'm hanging out with a guy who says that he's trying to keep me young for the next 50 years. He says we can live to 100 to 120 years old. That's a big bucket of money. So that's my answer is that I don't have a number. I have a passive income number, which is whatever my expenses are and my lifestyle. So as my lifestyle creeps, I got to creep my passive income up with it.
That's incredible. Awesome. All right. If you could have dinner with someone dead or alive, who would it be?
We're down here in Texas, and have y'all heard of there's a place called the Alamo. Y'all know the Alamo?
Yes, yes.
Okay, so it's a history thing. It's where Mexico came and invaded, and there's a last stand at the Alamo. The commander there was a guy named William Travis, and he had his chance to save his men and surrender, which might have had some negative consequences for the Texas bid for independence against Mexico. And so he decided to stay and fight, knowing that against 286 guys against 3,000 opponents, that he knew they were going to die. And so I'd like to sit with him and ask him how he had the courage to press forward in the face of obvious and imminent defeat and death.
Got it. Is his picture on your website? There is somebody on a horseback on your website. Is that him by any
It's
chance?
close. It's close. That's Stephen F. Austin, sort of to signify that's Stephen F. Austin on a horse to signify that we were founded in Austin, Texas.
Got it.
Oh, got
Got
it.
Got it.
Okay, right on. All right, next question. If you weren't doing what you're doing today, what would you be doing now?
I would either be a professional hunter or a travel agent. I like to travel, so
Nice.
that's a simple answer. I just know that's what I'd want to do.
Right
Yes,
on, right
yes.
on. My favorite question, book smarts or street smarts?
Oh, I prefer street smarts any day because I've been too book smart before and realized I needed some street smarts.
To really make things
So
happen. All right.
yeah,
Okay,
keeps you out of trouble.
yeah, there you go. Last question, Dr. Burns. If you had $1 million cash and you had to make one investment today, what would it be?
Wow. I'm conservative. I'd find something that produced, a good 8 or 10% cash flow, at least with some upside. So I'd probably stick it in one of our apartments.
Yeah, there you go.
Absolutely.
I've got some,
Multifamily.
and then there's some technology investments as well. If it was an extra $10 million, I'd plop it into one of my tech funds. But in a perfect world, or I would probably always be in some sort of real estate because it's just not going away.
Nice,
Awesome.
awesome. Really
Awesome.
appreciate that.
Dr. Burns, what's the best way people can reach you?
They can read my website's richdoctor.com, and you can email me at tom@richdoctor.com. So got some things on the website that are free to use and kind of help folks on their financial journey.
Amazing. We really appreciate your time. Thank you for coming on and giving us your time and giving us advice. And I'm sure many physicians around the world will take advantage of all the advice and wisdom.
Absolutely, and your wealth and
give us.
knowledge. So thank you so much for being here.
Appreciate you guys. Y'all are great. Thank you.